Hello, financial accounting students. I hope you guys have a pretty good grasp on Chapter 1 and are ready to dive into Chapter 2. So Chapter 2 is going to build on everything we learned in Chapter 1 in terms of understanding how to record transactions under the accounting equation, preparing financial statements, etc. But we're going to keep building on those concepts. So the first thing we need to do is understand accruals and deferrals. So we're going to learn how to show accruals and deferrals in our financial statements, starting with accruals first. And I want to define a couple words for you. First one's being accrual and deferral. So here's some definitions. So first we have to remind ourselves of cash basis versus accrual basis accounting. So when we use cash basis versus accrual basis, it leads us to these two words, recognize or recognition, or realize or realization. So when we say recognize or recognition, that's when we formally record an economic item, meaning a transaction or an event, into our financial statements. So that's when we record it. That's not necessarily when cash changes hands, right? Because we understand cash versus accrual basis. Realize or realization is when cash changes hands. That's when cash is paid or collected. It could be from collecting from sale of products or services, or it might be paying when we owe money to a vendor or to employees, etc. So recognize versus realize, and those concepts go along with the idea of cash basis versus accrual basis. So again, recognize is when we record it, regardless of when cash has changed hands, and realize is when cash has actually changed hands. So that leads us to the words accrual and deferral. And again, I say accrual. I can't stand it when students say accrual. The R is before the U. A-C-C-R-U-A-L, accrual. So within accrual basis accounting, you're going to find accruals and deferrals. Deferral basis accounting doesn't exist. That's not a thing. I get students that get confused about that they think we've learned accrual basis in week 1 and then deferral basis in week 2. That is not the case. There is no deferral basis. Accruals and deferrals both happen within accrual basis accounting. And so accrual basis, under accrual basis, we're going to come across these two things. And today I want you to challenge yourself to try to see them when we come across these transactions. So an accrual transaction is when we recognize the transaction before we realize it. So that would be something like we record that we have revenue, we made sales, or we provided services, but we haven't collected it yet. So we don't realize the transaction. We'll collect the money later. A deferral would be just the opposite, where we realize before we recognize. So cash changes hands first, and then we recognize the revenue or expense later. And I do want to point out the word recognize really only applies to revenue and expense. You can only recognize revenue and expense. You don't recognize assets and liabilities and common stock. So this means we're going to recognize revenue or expense before we realize it with cash changing hands. That would be an accrual. Or a deferral, cash will change hands before we recognize the revenue or expense. Hope all that makes sense. We'll try to apply that terminology as we go here. So we're going to look at receivables in these upcoming transactions. So we're looking at the company Cato Consultants. Cato Consultants was started on January 1st, year 1, when it acquired 5,000 cash by issuing common stock. Now we talked about this last chapter. Somebody went through the effort of forming this corporation, and they don't just magically acquire cash. Somebody put their hard-earned money into the business as an investment. So we've recorded this before. Let's keep practicing. What two accounts are affected here? It's cash and common stock. And you'll see here we're using the expanded horizontal financial statements model. So we have extra columns over here for revenue, expense, net income, and then cash flows. So we've got lots of extra columns today. So I know the print is a little bit small on the screen, but let's see if we can keep track of all of this. So we got cash in from issuing stock. So cash goes up, common stock goes up, and then there's no impact on retained earnings and therefore none on revenue or expenses. But our cash flow is financing activities. Remember, those stockholders or investors, those are the financiers of our business. Event 2. During year 1, Cato Consultants provided $84,000 of consulting services to its clients, but no cash has been collected. Okay, so we did all the work, but we've collected nothing yet. So let's start with the part we know. We provided the services, we did the work. So that's going to go under retained earnings. And remember, when we put something under retained earnings, we need to answer the question, why? Why did we put that there? Is it revenue, expense, or is it dividends? And in this case, it's revenue. We did the work, we provided services. And then on the other side, instead of receiving cash, we sure wish we got cash, but nobody has paid us yet. So we have a new asset called accounts receivable. So our assets are going up by $84,000. We wish our cash was going up, but it's not. Accounts receivable is a specific asset account for what our customers or clients owe us from doing what we're in business to do. So our customers collectively owe us $84,000. Before we move on, I just want a quick refresher on the accounting equation. Okay, so hopefully all of you remember the accounting equation. Assets equals liabilities plus owner's equity. And remember, owner's equity we break down into common stock and retained earnings. And then within retained earnings, we break that down into net income and dividends. So net income contributes to retained earnings, assuming it's positive. Dividends take away from retained earnings. Net income is made up of revenue minus expense. Let's see if you guys can help me mark this up a little bit. So when I earn more and more revenue, what does that do to my net income and therefore my retained earnings and owner's equity as well? Does it increase or decrease? I'm putting a plus there because it makes it increase, right? Revenue makes net income go up and therefore retained earnings and owner's equity. How about if we incur more and more expenses? What does that do to net income, retained earnings, and owner's equity? I hope you said it's going to make it decrease. So expenses are going to take away from net income, retained earnings, and owner's equity. What about when we pay out dividends? What does that do to retained earnings? Also decreases it. All right, what else can we mark up here? What's this blue circle represent? That's our income statement, right? And then from the very end of chapter 1, something we'll talk more about today, these accounts down here, revenue, expense, and dividends, those are all called temporary. Sorry, I'm writing right off the edge of the screen. Temporary accounts, and they'll get closed out into retained earnings at the end of the period. Okay, so we've had a little refresher. Hopefully that helped make more sense of event 2, right? We earned the revenue, so it goes under revenue, which is going to cause an increase to retained earnings. And then our assets, specifically accounts receivable, are going up. Let's keep going. Event 3. Cato collected $60,000 cash from customers in partial settlement of its accounts receivable. So now we're collecting some of that $84,000. This is not a new additional $60,000 of revenue. This is just collecting what we previously earned. So event 2 was an accrual transaction, and now in event 3, we're realizing by collecting, at least partially collecting. So what two accounts are going to be affected? Well, cash is going to go up and accounts receivable is going to go down. So here we see cash going up by $60,000, accounts receivable going down. So this is an asset exchange transaction, and then nothing is happening on the whole right side. So nothing on the right side here. What I really want to emphasize is that we do not have more revenue. There's no more revenue here. No more revenue, because that revenue was already recognized in event 2, which was an accrual, and now in event 3, we're collecting. So of course, when we collect, our cash flow type is going to be OA. We're collecting money in from customers. All right, event 4. Cato paid the instructor $10,000 for cash for teaching training courses. So I don't know, I'm hoping you read the chapter, but Cato Consultants teaches corporate training courses. So they've got to pay their instructor for teaching training courses. So they're just going to pay it and expense it at the same time. So this is neither an accrual nor a deferral. We're going to recognize the expense and realize it all at the same time, just like we did in all of chapter 1. So cash is going down by 10,000 and retained earnings is going down by 10,000. And again, remember, when we put something in retained earnings, we need to ask ourselves why: revenue, expense, or dividends. And this time the answer is it's salary expense, which is going to bring down our net income and therefore bring down our retained earnings. The cash flow type is OA. Paying our employees is a normal part of running our operation. Event 5. Cato paid $2,000 for advertising costs. The advertisements appeared in year 1. Now, I want to address the second half of that. The advertisements appeared in year 1 in just a moment, but let's deal with the first part. Cato paid $2,000 for advertising costs. So what two accounts are affected? Well, if we paid out $2,000, sounds like cash is going to go down by $2,000. And then retained earnings will go down. Why? Because we have advertising expense. And again, the cash flow type is operating activity, OA. Both the last two transactions are both what we call asset use transactions, right? Both sides of the accounting equation are going down. I do want to take note of this sentence here. The advertisements appeared in year 1. Well, that's nice. I think that would have been our basic assumption, but it begs the question, well, would we do this differently if these advertisements appeared in if the advertisements were for year 2 or year 3, that we were paying now for advertising for a future accounting period? Yeah, that actually would change how we record the transaction. Remember, we want to match our expenses to the period that they belong to. So we can go ahead and expense the advertising now because it belongs to this year. But if we were paying now for advertising services for the future, we would treat that differently. We'll touch on this later in the chapter, but what it would do is take away from cash, just like you see here, and then we'd have a new asset account called prepaid advertising, and we'd be increasing prepaid advertising rather than expensing it now. Remember, we want to match the expense to the period in which it's incurred. So if it's a future year, we're going to hold off expensing it until that future year. A little bit complicated, but we'll touch more on it later in the chapter. Now we're going to take a look at payables. At the end of year 1, Cato recorded accrued salary expense of $6,000. The salary expense is for courses the instructor taught in year 1. However, Cato will not pay the instructor cash until year 2. So listen, this is a super common accrual that we deal with in accounting. Workers do their work, but it's the end of the year or the end of the accounting period, and it's not payday. This happens all the time and is one of the most common accruals that you will see. So workers have done their work, but they don't get paid instantly for the work. They have to wait until their next payday. So let's say that you've been working the last half of December all the way up to the end of the month, but it's not payday until the following Friday, which is in January of the next year. So that's the situation we're looking at here with Cato. Instructors did their work at the end of the year, but it's not payday yet. So we're going to do a salary accrual. And what this means is that we're going to recognize now and realize later. Remember, the definition of accrual transaction is recognize before realize. So we're going to go ahead and recognize salary expense now, which is going to bring down our retained earnings. And then we're going to have a liability specifically called salaries payable. And that represents what we owe to our employees. So we use salaries payable when we owe money to our employees. So we're going to pay them when it's payday, but that doesn't happen to be December 31st. It's going to be later in January that we'll pay them. So again, we've got an accrual transaction where we recognize the expense now, which is bringing down our retained earnings, and then we have salaries payable, indicating that we're going to pay those employees later. Please notice that the cash flow is nothing because we haven't paid them yet, right? There's nothing in the cash column and therefore nothing in the cash flow column. So this is a claims exchange transaction. I think that's our first time seeing a claims exchange transaction. And what that's referring to is that we're pushing numbers around on the right side of the equation. When it's on the asset side, the left side of the equation, we call that an asset exchange. Here instead, we have a claims exchange. So liabilities are going up while retained earnings is going down. Event 7. Cato signed contracts for $42,000 of consulting services to be performed in year 2. Well, that's nice. I'm really happy to know that, but guess what? There's really nothing for us to do here. How do we know? 3 questions. Did we earn anything? Well, have we done this work yet? Nope. Did we incur anything, meaning expenses? Nope. And did any cash change hands? No. So I'm really glad to hear that they've got work lined up for next year, but it's not an accounting transaction yet. Did I earn anything? Did I incur anything? Did cash change hands? No, no, and no. So no transaction. So we keep going. So next thing they want us to do is to prepare our financial statements, and they kind of just throw us ahead. Here, they're done for you. That's a little too quick for me. I think I would go to the summary of transactions in your textbook. I believe this is on page 76 in your ebook, and so this walks through the transactions that we just recorded. So here's your summary of transactions. A couple things I want to point out. Remember, we had earned $84,000 of revenue, but we didn't collect it. And then in the next transaction, we collected $60,000 of it, which leaves our ending accounts receivable at $24,000. Does that make sense? We earned 84, we collected 60, so they still owe us another $24,000. And then you see the rest of the transactions all recorded here. And then beneath that, they've also shown it in the form of general ledger accounts. And this is a good format to look at and study a bit, as it's going to help us as we transition into chapter 3, where we're actually going to learn debits and credits and T accounts. Sorry, the edge of the page is cut off a little bit, but I think you get the idea. Again, I recommend visiting page 76 in your book. So with this information, can we prepare our financial statements? So if you were picturing your income statement in your head, that's revenue minus expense. So where would we find that data? The blue numbers over here on the right under retained earnings. So 84,000 was revenue, 10,000, 2,000, and 6,000 were all expenses. There was no dividends. So if we're going to do revenue minus expense, that would give us our income statement. Can you figure that one out? Our next statement would be statement of changes in equity. And so we'd walk through 2 columns, common stock and retained earnings, right? We're going to break down our stockholders' equity and walk through those 2 columns. So it'll start out with beginning common stock was 0. During the year, we issued 5,000, and therefore we ended with 5,000. Under retained earnings, we're going to say we started with 0, and then we had net income of how much? 84,000 minus 18. We had net income of 66,000. We paid out 0 dividends, and therefore we ended at 66,000. So that would be our stockholders' equity, statement of changes in stockholders' equity. Our balance sheet is going to be these red numbers across the bottom of the equation here. And then what about our cash flows? Where will that come from? Well, in this format, we'll just use the cash column. So 5,000, that was FA. 60,000 is OA. 10,000, that was to pay expenses, so that's OA. And 2,000, that was to pay expenses as well, so that's OA. So I guess now that we're armed with all that knowledge, now we can actually prepare those financial statements. So that's where all these numbers are coming from. I know this is in real small print, so look at the version in your book if you can't read it here, but also challenge yourself. See if you can prepare these on your own. And also remember that word from last chapter that we learned, articulation, which is the interrelationship among the financial statements. So we see that in a couple places here. First, our net income from the income statement ties down to the statement of changes in equity. And then our ending numbers from the statement of changes in equity, 5,000, 66,000, and 71,000. So this, and this, those all repeat down here, 5,000, 66,000, and 71,000. And then another one to notice is that our cash on our balance sheet also ties down to the bottom of the statement of cash flows. So lots of connections in our financial statements. When we look at our income statement versus our statement of cash flows, the operating section in our statement of cash flows, why aren't they the same? Well, maybe a better question is, why should we expect that they would be the same? We really shouldn't when we're talking about accrual accounting. But here's the differences that we're looking at. If we're using accrual basis, but if we were to use cash basis, it would look like this. So we earned 84,000, so accrual basis says, yep, that's all revenue. But cash basis, we only collected 60,000, and that's what's going to show in our statement of cash flows. Accrual basis, we had salary expense of 16,000, but remember 6,000 was a year-end accrual that we haven't paid yet. So cash basis, we would only have 10,000, and that's what will show on the statement of cash flows. And then no change in the advertising expense. But just in a handful of transactions, we can already see a significant difference between accrual basis and cash basis. So the OA section of the statement of cash flows, the operating activity section of the statement of cash flows, mimics what our income statement would look like if we were using cash basis accounting. But we're not. So there's good reason to have both and to study both. So the statement of cash flows helps us understand money in, money out, while the income statement using accrual accounting helps us understand what we've earned and what we've incurred. So our next topic is to understand the steps in the accounting cycle. So the last step in the accounting cycle, which we'll take a look at shortly, is what we call the closing process. And we touched on this at the end of chapter 1. The closing process does two things. It transfers the balances from our temporary accounts, which are revenue, expense, and dividends. So they say net income or loss, that includes revenue minus expense, and dividends, and it transfers those balances into retained earnings. And then in doing that, it's going to reset those accounts back to zero. So all revenue, expense, and dividend accounts get reset back to zero, and their balances get dumped into retained earnings. As a reminder from last chapter, temporary accounts, again, are expenses, revenues, dividends, where everything else, essentially ALLO, your accounting equation, those are all permanent accounts. They're going to roll forward from year to year, and those balances from the end of year 1 become the balances at the beginning of year 2. So big picture, the whole accounting cycle, let's look at it in a picture form. The whole accounting cycle, we start by recording transactions. At the end of the accounting period, we have to make adjusting entries or adjust the accounts, and we're going to learn some of that today. Adjustments usually arise due to deferrals, and so we'll touch on that here shortly. Then we prepare our financial statements. Then we close the nominal accounts. Nominal is another word for temporary. So we'll usually call them temporary accounts, but they've used the word nominal here, which is synonymous with temporary in this case. And then it all starts over again. So we record the transactions, we make the adjusting entries at the end of the period, we prepare the financial statements, we close out the temporary accounts, and we start it all over again. That's the accounting cycle. Also, as a refresher, is the matching concept. And again, we talked about this back in chapter 1. The matching concept is my favorite gap. And so I want to remind you, it has 3 parts. Number 1, we want to match our revenue to the period in which it's earned. Number 2, we want to match our expenses to the period in which they are incurred. And number 3, sometimes but not always, we want to match our expenses to the revenues they generate. So the application of all 3 of those tells us that we need to be using accrual basis accounting. Here they tell us cash basis accounting can distort the measurement of net income because it sometimes fails to properly match revenues with expenses. I'm even going to say, as much as distort seems kind of like a strong word, I'm going to even say manipulate. Cash basis accounting can manipulate the measure of net income. If somebody actually knows what they're doing, they could actually use cash basis to manipulate their net income. So let's say that you want your business to look as good as possible this year because you're going to be applying for a loan. So you want to look like you're in good financial health, even if maybe you're not. And so you decide to just not pay your bills for the last 2 months of the year, which is going to be problematic for you down the road. But at the moment, if you're using cash basis accounting, what that does is eliminate those expenses. Those expenses don't get recognized until cash changes hands under cash basis. So we could reduce our expenses and make our net income look stronger by just choosing not to pay our bills, which is really not a good behavior. That is not a behavior that should be rewarded with a stronger net income. So that would be an example of how somebody might use cash basis to intentionally manipulate their net income and actually deceive the reader of the financial statements, which we have all kinds of problems with that. So the problem is that cash is not always received or paid in the period when the revenue is earned or when the expense is incurred. So some of this can just be accidental distortion, but in my example, I explained how we could use cash basis to intentionally manipulate our accounting. And to me, a basis of accounting that is wide open for that type of manipulation is problematic in and of itself. The objective of accrual accounting is to improve the matching of revenues with expenses. Remember that little nugget. I think you have a test question on that. Next, we have another gap, which is the Conservatism Principle. So one of our generally accepted accounting principles is conservatism. And let me be clear, this has nothing to do with your political views, conservatism versus liberalism, none of that. We're talking accounting only here. So conservatism is the idea that when we're faced with what we call a recognition dilemma, when we're not sure how to record something in accounting, conservatism guides us to select the alternative that results in the lowest amount of net income. And I could expand on that and say also the lowest amount of assets or the highest amount of liabilities or the highest amount of expenses. What we're going after is we never want to make our financial statements look better than they actually are. We never want to paint a picture that is better than the truth because we could potentially be deceiving the readers of the financial statements. When we talk financial accounting, we have to keep in mind the end users of the financial statements. We have a duty to them to report our financial statements as accurately as possible. But there will be times in accounting when there's a little gray area or we're not quite sure how to do something, and conservatism says always go with the choice that results in the lowest amount of net income. That way we're not overstating something. We don't want to deceive those readers of the financial statements. That is a major no-no in accounting. So conservatism. Just in these first 2 chapters, we've learned several gaps already. Can you remember what they are? The matching concept, historical cost concept, reliability concept, And now the conservatism principle. So we're just learning gaps as we go, not things that we have to memorize, but just understand and be comfortable with these ideas. So next we're going to get into deferrals. And as I alluded to earlier, most of the time that we have a deferral, it's going to result in a end of period adjusting entry. So we have to be able to adjust for those at the end of the period. And I'll explain a little bit more about how and why in just a moment when we encounter that. So first we're going to look at how supplies affect our financial statements. So it's the beginning of our second year. And if you remember at the end of year one, we had accrued $6,000 in salaries. And now we're actually going to pay those salaries. So now we're paying off the accrual from the previous period. So Cato pays $6,000 to the instructors to settle the salaries payable obligation. So cash is going down and salaries payable is going down. So both sides of the equation are going down. It's an asset use transaction. And then our cash flow is OA. When we pay our employees, whether it's on time, early, or in this case, after the fact, it's OA. One thing I do want to point out is that we don't expense the $6,000 again. It was already expensed in the period in which it was incurred, which was the first accounting cycle, year one. So our second transaction, Cato purchased $800 of supplies on account. So what are supplies? Well, supplies are an asset. It's stuff we have, but supplies specifically are an asset that we're going to use up in the process of doing what we're in business to do. There's something that gets used up or consumed in our normal work process. So the simplest example that would apply to most businesses would be office supplies. Most every business has some amount of office supplies. Other businesses, depending on what industry they're in, they might have a ton of supplies, maybe potentially very expensive things that get used up in the process. So again, that depends on what type of business we're talking about. In my accounting firm, our supplies are quite simple: paper, toner for the printer, pencils, post-it notes, basic mailing, shipping supplies, that type of stuff. But I have a client that runs a metal brazing business. So he's got all these same office supplies that I have, but then on top of that, he's got supplies that go into his metal brazing process. So metals and salt and all kinds of things that go into their actual process that they do there. So totally different set of supplies. I have another friend that runs a painting business. So he's got different supplies. He's got tape and tarps and pans and trays and paint brushes. So again, different set of supplies there. But the point is that all of these supplies, they start out as an asset because they're stuff we have, and then they get consumed in the process of running our business. In the real world, a lot of businesses will just expense their supplies right away. That's not technically GAAP, so there might be a time and a place for that if it's small amounts and it doesn't have a material effect on the financial statements. But the technically GAAP way of doing it is to record all of our supplies as an asset, and then later we're going to make an adjustment to expense the amount of supplies that have been used up. So let's start here just with the first step. Cato purchased $800 of supplies on account. So supplies, the asset is going to go up, but then we need to talk about this phrase on account. What does that mean? I don't think we've seen that yet. On account. On account can have two different meanings, but essentially what it means is that cash is not changing hands right now. So they're going to pay later. Cato's going to pay the supplier of those supplies, the vendor, they're going to pay them later on. So when we pay a vendor later, we have a liability account for that called accounts payable. So accounts payable is specifically what we owe to our vendors. So what we see down here is that supplies, the asset is going to go up 800, and then the liability, accounts payable, is also going up 800. So this is an asset source transaction. Both sides of the equation are going up. And then notice that there's no cash flow involved because we didn't pay anything. So next, we're looking at an adjustment that would happen at the end of the year. So they're doing the transaction and then showing us the corresponding adjustment that goes at year end. And then we'll do another transaction and then the corresponding adjustment at year end, just so that we can connect the dots here. After determining through a physical count that $150 of unused supplies remained on hand at December 31st, Cato recognized supplies expense. So when they tell us this 150, that's what's remaining in our supplies account. So we have to compute how much has been used up and how much therefore should be expensed. So they show us the process. We take our beginning supplies balance, which is 0. We add the supplies purchased, so the total supplies available is $800. We subtract what's remaining on hand, which is $150 of supplies. So that's still stuff we have. We want that to remain in our supplies asset account. But then the rest of it, the other $650, has been used up and therefore should be expensed. So we're going to expense the supplies. We take them out of the supplies asset account, decreasing the asset. And then it's also going to decrease retained earnings because we have supplies expense, which is then going to reduce our net income. So this is an asset use transaction. Both sides of the equation are going down. I do want to point out that our supplies expense and our remaining supplies on hand have nothing to do with how much we have or have not paid our vendor. Remember, we owe that vendor $800 that was in accounts payable. It doesn't matter if or when we ever pay it. I mean, we should. We're going to run into trouble down the road if we don't pay our vendors, right? But whether we've paid that $800 to the vendor or not has nothing to do with the amount of supplies that remain on hand and the amount of supplies that we end up expensing. Next, we're going to look at prepaid items, and we touched lightly on this concept previously when we were talking about advertising. We're going to look at it a little more in depth here. So on March 1st, year 2, Cato signed a 1-year lease agreement and paid $12,000 cash in advance to rent office space. The 1-year lease term begins March 1st. Okay, so we're paying for a full year of rent, essentially. A full year of rent. Should we expense all of that right now? No, the matching concept says we want to match our expenses to the period in which they're incurred. So not all 12,000 of that belongs to March year 2. So what we're going to do is we're going to place all 12,000 into an account called prepaid rent. And that's going to be an asset. We're going to hold that as an asset until we've used up the rent, and we'll look at that through a year-end adjustment. So for now, cash is going down by 12,000, and our new asset account, prepaid rent, is going up by 12,000. And then later, we'll deal with expensing it. If you look back, the purchase of the supplies, and here also the prepaid rent we're dealing with, both of these are deferral transactions. Deferral transactions. So in this case, cash has changed hands. So we realize, and then we're going to recognize our rent expense later. We're not expensing anything yet. We're going to recognize later through a year-end adjustment. And our cash flow is OA. If we pay our rent early, on time, or late, paying the rent is still going to be OA. So as we think about prepaid items, we need to understand the relationship between costs, assets, and expenses. So some costs result in assets, which are sometimes deferred expenses, expenses that we put off until later. So prepaid rent, prepaid advertising, prepaid insurance is another common one. Even supplies. We hold it as an asset till it gets expensed later. And then when we use up the rent, the insurance, the advertising, the supplies, then we expense it over to something like rent expense, insurance expense, supplies expense. Other costs just get directly expensed. So we get our utility bill, we pay it, we have utilities expense. So next we're going to take a look at unearned revenue, which is another type of deferral. So Cato received $18,000 cash in advance from Westbury Company for consulting services to be performed over a one-year period beginning June 1st, year 2. So that $18,000 is going to be for work that Cato is going to provide in the future, starting on June 1st and ending in essentially the end of May in year 3. So that $18,000, first, we haven't done the work yet, and second, it doesn't all belong to this year. So what we're going to do is place that $18,000 into cash because we received it, but also into a new account called unearned revenue. That's a liability. It's revenue that we can earn in the future, so it'll convert to real revenue. But right now, it's just that we owe our client, we owe Westbury Company in this case, consulting services for a year, or at least their money back, but they want the consulting services. So it's a liability because we owe them the work or we owe them their money back. So on our accounting equation, we see cash going up $18,000, and then we see liabilities, unearned revenue specifically, going up $18,000. And cash flow is OA. This is money in from a customer. And whether that customer pays in advance, right on time, or after the fact, money in from a customer is always going to be OA. So that $18,000, we're going to start providing them with consulting services in June. Then at the end of the year, we're going to need to make an adjustment for that unearned revenue. So we have $18,000. We're going to divide it up into a monthly amount. So we divide it by 12 months in a year, and that'll be $1,500 of revenue, consulting revenue, that we can earn each month. And if we go from June to year end, so June 1st, the beginning of June, to the end of December is 7 months. Count your months carefully. 1,500 times 7, that means we have earned $10,500 of the unearned revenue. So we take away $10,500 from unearned revenue, and then we put it under retained earnings. Why? Because it's real revenue. So revenue is going up $10,500, net income's going up $10,500, and therefore retained earnings is going up $10,500. So this is a claims exchange transaction. We have a liability going down while retained earnings is going up. So again, we divide it into a monthly amount, count how many months went by, and then we take away $10,500 from unearned revenue, and we make it real revenue. So question for you, what's left in unearned revenue? What would be the remaining balance after this adjustment? 18,000 minus 10,500, the remaining balance would be 7,500, which represents another 5 months of revenue to be earned, 5 times 1,500. And we'll earn that in January through May of year 3. And forgive me, I'm going to jump back to adjustment 2 because we somehow skipped over that slide. So remember the prepaid rent? We had paid $12,000 in advance. This one, we paid $12,000 in advance for our prepaid rent. That also is a deferral. Cash changes hands first, then we're going to expense it later. The unearned revenue with Westbury Company, cash changed hands first, and then we're going to earn the revenue later. But let's look at adjustment 2 that goes with the prepaid rent. So same idea, we take the prepaid rent, the annual rent was $12,000, we divide it by 12 months to get our monthly cost, which easy math, we got $1,000 per month, and then we're counting up how many months went by. So this happened on March 1st of year 2. So if we're going to expense the rent from March 1st to year end, that's 10 months, right? The beginning of March to the end of December. Count those months carefully. That's $10,000 of rent expense. So we take $10,000 out of prepaid rent because it's no longer prepaid. We've used it up. And then we take it out of retained earnings. Why? Because it's an expense. So that expense is going up, which makes our net income go down, and therefore retained earnings will go down. And again, what's the remaining balance in prepaid rent? 12,000 minus 10,000. The ending balance in prepaid rent is 2,000. And that makes sense. It represents the other 2 months, the 2 additional months that go into year 3, because this was a 1-year lease starting on March 1st. So it represents January and February of the next year. So next we need to prepare our financial statements for year 2. But first they say, oh yeah, and there's also all of these other events. So let's just talk through these events. We won't write all of them out, but let's just talk them through. We provided $96,400 of consulting services on account. And this time on account means that we did the work, but we haven't been paid yet. Do you remember what that's called? Accounts receivable, an asset, accounts receivable. So what 2 accounts will be affected here? Accounts receivable will go up and retained earnings will go up because we did the work, we earned it, and therefore that's revenue, consulting revenue. Event 6, we collected $105,000 of cash from customers as partial settlement of accounts receivable. So now we're just collecting our accounts receivable. This isn't new revenue. So cash is going up and accounts receivable is going down, an asset exchange. Number 7, we paid $32,000 for salary expense. So cash will go down and retained earnings will go down because we have salary expense, which is going to bring down our net income and therefore retained earnings. Number 8, we incurred $21,000 of other operating expenses on account. There's those words again, on account. What does it mean this time? Is it accounts receivable or accounts payable? So take note, they use the same phrase on account for accounts receivable and accounts payable, and it's your job to figure out which one they're talking about. So it sounds like we incurred expenses, but we haven't paid them yet. So do we owe money to somebody else or does somebody owe money to us? We owe money to somebody else. So that's a liability. That'll be accounts payable. So $21,000 is going to increase in accounts payable, and then retained earnings is going to decrease $21,000 because we have operating expense, which is going to bring down our net income and therefore retained earnings. Number 9, we paid $18,200 in partial settlement of accounts payable. So now we're just using our cash to pay down some of that accounts payable. So take $18,200 out of cash and $18,200 out of accounts payable. So an asset use transaction, both sides are going down. There's more. Event 10, we paid $79,500 to purchase land for use in the future. So that's going to decrease cash and increase land. So an asset exchange transaction. Event 11, we paid $21,000 in cash dividends to the stockholders. So that is going to reduce cash and it's going to reduce retained earnings. So retained earnings is going down, this time for dividends, not revenue or expense, but instead for dividends. Number 12, we acquired $2,000 cash from issuing additional shares of stock. So cash is going up and common stock is going up. And then finally, we have one last adjustment in addition to the other three that we did. Our adjustment is for accrued salary expense. So like at the end of year one. So workers have done their work, but it's not payday today. We'll pay them in January. So we need to recognize the expense, but we're going to pay them later. So retained earnings will go down because we have salary expense, which is going to bring down our net income, bring down our retained earnings. And then salaries payable, the liability, will go up, which is a claims exchange. So I've jumped over to your ebook and we're looking at roughly page 87, and it goes through the rest of these transactions. So remember, we did the first several together and some of the adjustments, and then we just did 5 through 12 verbally. But if you look down the page, you'll see that they've got this arranged into ledger accounts. So across the top, we still see the same assets equals liabilities plus stockholders' equity. Let me scroll over to the right. So all of those accounts are there, but rather than having a separate column for each, they've just given each kind of a little space. So cash has this big chunk up here, and then we have accounts receivable and supplies, prepaid rent, and land. So they're organizing it this way for two reasons. We start to have too many columns that our accounting equation becomes impossibly wide and we can't really fit it properly on a screen. But secondly, because next chapter, in chapter 3, we're going to learn the concept of T accounts, and it will be more similar to this format. But we can still look through these ledger accounts and say, okay, my ending balance in cash is $9,300, ending balance in accounts receivable $15,400, ending balance in supplies was $150. That's good because that's the amount of supplies that we counted up. Prepaid rent is $2,000, land $79,500. So we can still find all of our ending balances. We can see the detail that goes into each account, but it's in a different format. What I really want you to pay attention to, if I go over to retained earnings, the only thing that has been entered directly into retained earnings is the beginning balance of $66,000, the balance that rolled forward from year one. Everything, revenue, expense, dividends, all those temporary accounts, they all have their own account where we're storing that data. So our dividends are here, and then we have consulting revenue, and then we have the rest of our expenses. So they've all been recorded in their individual temporary accounts. And then it will be through the closing process that we're going to take revenue, expense, and dividends, wipe them out, and dump them into retained earnings. So they're not in retained earnings yet. And this format allows us to see it by having more detail available for the temporary accounts. So then that leads us to the financial statements. And there is a slide in the PowerPoint that has these financial statements, but I think it's very difficult to read. So I think looking at I think we're on page 88 in your textbook now, 87, 88, somewhere in that range. I think seeing it in this format is a little bit more readable. I like how they have arrows about the page showing us that our ending common stock from year one becomes our beginning common stock year 2. Ending retained earnings from year 1 becomes beginning retained earnings year 2. And then these ending common stock and ending retained earnings numbers repeat themselves down here on the balance sheet. And if you remember, that is called articulation, the interrelationship among the financial statements. So there's the financial statements in full. If you're stuck on your homework, page 87, 88, 89, it's a good place to visit to see all the transactions that we recorded, including those adjusting entries, and then see the financial statements that result from that. So refer back to this little section often if you're stuck on your homework. It should offer you some guidance. Next, we're going to classify accounting events into one of 4 categories. We've actually been doing that as we go. In Chapter 1, we only had 3 categories, but now in Chapter 2, we've added a 4th. So asset source is when both sides of the equation are going up. Asset use is when both sides of the equation go down. Asset exchange is when we're pushing numbers around on the asset side, on the left side of the equation, like using cash to buy land. And then a claims exchange is when we're pushing numbers around on the right side of the equation, the liabilities and owner's equity side of the equation. So an example of that would be like when we make the adjusting entry to turn our unearned revenue into real earned revenue. So it's moving from being a liability into being revenue, which is going to increase retained earnings. So liabilities would go down while retained earnings go up. Also, just as a reminder, I said it earlier, but I think it bears emphasizing. When you record a deferral transaction, that means that cash changes hands first, and then revenue or expense will be recognized later. Examples would be prepaid rent or unearned revenue. Cash changes hands first, and then we'll recognize the revenue or expense later. Later is through a year-end adjustment. So deferral transactions most often result in year-end adjusting entries. And so that's what we were learning through adjustments 1, 2, 3, 4 in the second half of this chapter. So deferral entries usually result in a year-end adjustment. Corporate governance, what is it and what does that mean? So corporate governance is the set of relationships between the board of directors, management, shareholders, auditors, and other stakeholders. Not stockholders, but stakeholders. And a stakeholder can be really anybody who's affected by the operations of the business. That could include employees, customers, vendors or suppliers, the community in which the business operates. So stakeholders can include a wide range of different people, but corporate governance is the relationships, the set of relationships, and how we get all these different parties to function. So set of relationship, even we could say the set of rules and guidance in there. Why does that matter? Why is it important? Well, we're going to be talking a little bit about financial statements and audited financial statements. So they threw in auditors as part of that. Corporations that need audited financial statements, so really any publicly traded financial statement and any other company that needs audited financial statements for their investors or creditors, they have to hire an outside auditor to audit them, not somebody internally, an outside auditor. And so that's what a lot of accountants do. They provide audit services and they audit the company's financial statements. So when the auditors are auditing the company, it's not really the auditors against the company, but the auditors share the same objective as the company, that they want them to put out the most accurate financial statements for the readers of their financial statements. They don't want the readers to be confused or deceived in any way. So the auditors are going to present their audit findings as they're working on the audit. They're going to go through the financials. Now, they don't look at every single number. We'll talk about that in a later chapter. But they're going to go through the financial statements, and if they find something wrong, they're going to present it to management or even the board of directors and give the company an opportunity to make it right. That's the whole point, is that we want the financial statements to be right. So those auditors are going to go to management and say, hey, we came up with these handful of problems. What can we do about this? How do we fix it? So they would then need to correct the numbers on the books, but then also they're going to look at what went wrong here. How did we get off? Was there fraud? Was there laziness? Was it just mistakes? Did we miss a step? So the auditors are also going to help the company look at what we call their internal controls, and we'll fully address internal controls in chapter 6 later this semester, but they need to have a strong relationship with their auditors. The auditors need to be brutally honest, management needs to be brutally honest, and they need to share that objective of arriving at the most correct financial statements possible. In accounting, ethics are incredibly important. However, I will say that sounds a bit cliche. They say the accountant's role requires trust and credibility. Ethics are important to the accounting industry. That's absolutely 110% true. But what profession says, nah, ethics aren't real important to us. We really don't care about trustworthiness and credibility. Who cares? Well, most industries aren't going to say that, but I think it couldn't be more true than in accounting. Some of you are probably thinking in the back of your head, no, I can think of some industries where we don't care about credibility and trustworthiness. Well, in accounting, it certainly is important. And I really will say, I think it's the most important. Their point here, accounting information, including our financial statements, are worthless if the accountant is not trustworthy. And the prime example of that would be Enron. Some of you may not be old enough to remember it, but you should at least go back and look it up in the history books of 2001, 2002. Giant energy company called Enron, and they had hired Arthur Andersen, which is at the time was one of the big 5 accounting firms. So Arthur Andersen is a giant worldwide accounting firm, had been around for 100 years, had 88,000 employees throughout the world. In my opinion, the most well-respected of the big 5 firms. Not that any of them were disrespected, but it had an excellent reputation. Arthur Andersen was an excellent firm, top-notch reputation, known for its trustworthiness and credibility. So Enron had been doing all kinds of, let's just call it creative accounting, cooking the books. They were really doing some bad things over there at Enron, and I don't have time to get into all of it now. If you're interested, to me it's really fascinating what they were doing and how horribly wrong all of it was. But the crazy idea that they came up with, it's all quite fascinating. But they're doing these bad things in their accounting, and Arthur Andersen is their auditor. So, and how that works, so big giant accounting firm, and there's going to be many partners in this accounting firm, but probably one partner that's in charge of Arthur Andersen as a client, and then numerous accounting managers and staff accountants underneath. So lots of people working on this audit. And I mean, this is a huge company and a huge job, probably year-round audit work. So they're paying a lot of accounting fees. Enron is paying a lot of accounting fees to Arthur Andersen to conduct their annual financial audit. So I would suspect in the process, these auditors are coming across some things that look a little strange, and then might point it out to their manager, and their manager might take a look, or the partner that's in charge, And a couple of these managers might look at some of these numbers and say, where is that coming from? Do we need to ask more questions? Do we need to dig deeper? And it seems that they just turned their heads and looked away. They swept it under the rug. Rather than asking the hard questions, rather than digging deeper, a handful of accountants, not 88,000, just a couple of accountants, decided not to press on the hard questions. And they may have said, we'll deal with it next year. It doesn't seem like a big deal. I'm sure there's an explanation for it. But they never pressed. They never dug deeper. I don't know if they knew the truth as to what Enron was doing. But essentially, they artificially inflated their balance sheet and transferred their liabilities out to kind of another shell company. So they're definitely inflating their balance sheet, making the company look much better than it actually was. The company was actually in financial trouble, and their financial statements said they were doing fine. And in fact, the stock market was going crazy. Enron stock was going up because they were supposedly doing so well. So eventually a whistleblower at Enron reports that they don't know quite what's going on, but something's wrong, and they flag it to the government and come to find out that Enron is doing all kinds of bad things, and immediately the stock crashes. So the stock price drops dramatically. Everybody who's invested in Enron, which was a lot of people, not just Enron employees, lots of Enron employees lost, their retirement savings, but tons of people were invested in Enron, including other companies' retirement funds, lots of people in the stock market, and really throughout the world. So Enron stock tanks, lots of people lose money there. Lots of people at Enron are losing jobs because Enron's now not doing well suddenly. But then somebody says, well, wait a minute, aren't these financial statements audited? How did this get through? How did they not pick up on this? Who's the auditor? So now all eyes go to Arthur Andersen, the accounting firm. How did they not catch this? What happened on the audit that they didn't discover that something was wrong? Well, I think this example shows us exactly this point about accounting information is worthless if the accountant is not trustworthy. Because what happened next? Arthur Andersen had thousands of clients throughout the world, but suddenly their name became associated with this huge audit failure at Enron. And most of these people that were doing these audits were doing an excellent job, top-notch work, no reason to distrust them. But suddenly the name Arthur Andersen was not okay anymore. So all of their clients said, I'm sorry, I can't be associated with Arthur Andersen. They're known for bad accounting and for bad audits. We can't be associated with you. So it goes to the point that our accounting information is considered worthless if the accountant or even the accounting firm is not considered trustworthy anymore. So suddenly all their clients jump ship, and the accounting firm, Arthur Andersen, that had been around over 100 years, goes down. It disappears. It fails within approximately 6 months. So this was a huge deal in the accounting industry. This is the Enron scandal, and the Arthur Andersen audit failure was all over the headlines at a time that our country was already in bad economic shape and in rather poor spirits. Keep in mind, all of this is happening just after September 2001. So we've had 9/11 followed by stock market crash and stock market volatility. And then right after that, this Enron Arthur Andersen scandal breaks the news. So really a tough time. Out of all of this came a few pieces of legislation. We'll get to those. This is referring to the AICPA Code of Professional Conduct. I'm not going to read it at you, but essentially it it says that accountants, CPAs, those conducting audits who are going to be CPAs, certified public accountants, need to operate, I think this highlights it, they need to operate in a way that serves the public interest. So at any moment, we need to remember that we're not serving our client, we're not serving our firm that we work for. Our duty is to the readers of the financial statements, anybody who might read the financial statements and rely on that information. So our first duty is to serve the public interest, not our client, not our accounting firm. So that's from the AICPA. That says the same thing. So from this time frame, there's a few audit failures of that time frame, Enron being one of them, WorldCom, I want to say Tyco was around the same time. All of these companies had big scandals going on. And so legislation went through that was the Sarbanes-Oxley Act, which we call SOX. I know, accountants and their acronyms. So part of SOX, it created the Public Company Accounting Oversight Board. And again, another acronym in accounting, we call it peekaboo. I know that the letters don't match up quite right, but that's what they call this, the Public Company Accounting Oversight Board, which is referred to as peekaboo. Additionally, it requires management to certify the financial statements. And this provision in particular, I think, came out of the WorldCom scandal. I believe it was the WorldCom scandal where the CEO pretty much said, hey, I'm not the numbers guy. I don't really know what's going on. It was the CFO. Blame him as the chief financial officer that screwed this up. I'm just the CEO. I really don't know. That's a pretty unacceptable answer. If you're the CEO of a major publicly traded company, you don't get to claim ignorance. Sorry, I'm not the numbers guy. That doesn't really fly. And then he throws the CFO under the bus and backs the bus up over him. So people looked at that and said, no, that's really not okay. All of management, CEO, CFO, all of them, they need to certify the financial statements. They can't just point fingers at one another. They all have to take responsibility for this. It imposes harsh penalties on management for violations, and that can include criminal jail time. So they can be prosecuted as criminals. They can go to jail. It's very serious. So let's take a look at what we call the fraud triangle. And the fraud triangle is made up of opportunity, pressure, and rationalization. So it looks like this. So let's say that we are the lead partner at Arthur Andersen in charge of the Enron audit. And this is very important to us and to our firm that we keep this client because they're paying us a ton of money, okay? I'm talking about millions of dollars a year in accounting fees to do their accounting work. It's a lot of money. So we feel pressure that we need to keep this client. So we need to keep that revenue coming into our accounting firm. We want to make the client happy. We want to make sure that they continue to be an Arthur Andersen client for a long time. So we have an opportunity to keep them happy. We've seen a few things that maybe we should be concerned about on their audit, but we've chosen to just kind of sweep it under the rug and not press them for more information. And that seems to make them happy that we're not bothering them for more details about some of these accounts, some of these somewhat suspicious accounts. So we feel pressure because if we lose the client, we're probably going to lose our job, and all of the accounting managers and staff accountants under us, they'll probably lose their jobs too. And they're all counting on their salary to pay their mortgage and for their car and for their insurance and to put food on the table and feed their children. So sure, a huge amount of pressure to keep the client and keep the client happy. So we find an opportunity to do that by not pressing them for more information on something, even though we probably should have. When I say probably, we definitely should have. We should have had a gut feeling there's something wrong with these numbers. Where are they coming from? And then we rationalize this by saying, well, I was just trying to do the right thing for our firm. I was just trying to protect my employees because I knew if we lost this client, they might lose their jobs. And we can rationalize until we're blue in the face. But to be really honest with you, anytime you have to rationalize your behavior, you need to question yourself, are you actually doing the right thing? If you're really doing the right thing, you probably don't have to rationalize, meaning explain it to somebody. Well, I did it because I was looking out for my accounting firm. I was looking out for the employees, and they need their salaries, and they have families to feed. And if I don't keep Enron happy, then Arthur Anderson could lose this client, and all those people could lose their jobs. So we rationalize it by saying, oh, well, I was looking out for someone else. But the bottom line here is in accounting, the people you have to look out for first are the public interest, the readers of the financial statements. So as soon as you think that you work for your client or you work for your accounting firm or you have to look out for your employees, and if that's what's guiding your decision making, then you're doing it wrong. In accounting, we have to put the readers of the financial statements first. At the end of chapter 2, there is an appendix that covers two topics, depreciation and interest. And I just want to briefly touch on these because we're going to study them later in the semester in a different chapter. But I think just having a quick idea that these things exist is helpful to our accounting education as we go. So first we'll take a look at depreciation. We're going to fully study depreciation in chapter 8. But depreciation is the process of expensing an asset over time. So we're going to, in this case, we're going to buy a forklift for a company, and then we're going to look at how to expense it over time. I'm not going to get real deep into this. So they pay $43,000 to buy a forklift, and that's a long-term asset, right? We're going to plan to use that forklift to benefit our business for multiple years. So down here we see cash is going down, and we have a new asset that is forklift going up, and our cash flow is IA, investing activity. And then over time, we're going to be depreciating that asset. So next, they're going to borrow $5,000 cash from the bank. So cash is going up, and then notes payable is going up. And this is a financing activity. So we'll deal with the interest on this loan a little bit later as we talk about interest. So now we own a forklift that's going to need to be depreciated, and we've taken out a loan from the bank on which we're going to need to accrue interest. What else is going on here? During year 1, Libby earned $16,000 cash by renting the forklift out to customers. So now we have revenue. So cash goes up, retained earnings goes up. Then what I want to show you, and we'll learn this later, is this concept of depreciation. And what that means is that we're going to use a method. In this case, they're showing the straight line method, and we're going to expense the forklift over time, specifically the period in which we benefit from using the forklift. And this is an example that we want to match our expenses to the revenues they generate. So if we're going to use that forklift for 4 years, we're going to expense it over time, that time being 4 years. And so they've done the math here. I'll teach you straight line depreciation when we get to chapter 8, so don't worry about the details of it. But the idea is that we bought an asset and then we're going to expense it over time. So here we're expensing 1/4 of that forklift. So we're expensing it to depreciation expense. And then we have this new account called accumulated depreciation. So just a brief introduction to that idea, and we will revisit that in great detail in chapter 8. Next, I wanted to just briefly introduce the concept of interest accruals. And in this case, we're looking at interest expense. Remember, we borrowed money from the bank. $5,000 on February 1st, year one. Well, that loan is going to be accruing interest as a function of time. Now, we don't have to pay the interest yet. Okay, we're going to pay back the loan and the interest all later. But interest is accruing as a function of time. So what we do is we take the principal of 5,000 times the interest rate of 6%, and then we multiply it by the time outstanding. Remember, it was February 1st. So from February 1st to year end is 11 months. February 1st to end of December is 11 months. So we take 5,000 times 6% times 11/12, and we need to accrue interest of $275. And what that means is that we're going to pay the interest later. So we have a new liability called interest payable. And then we have an interest expense of $275, which brings down our net income, and which is going to reduce our retained earnings. Oops, do you see the book made a mistake here? That should be minus 275 right there. Sorry, super sloppy, writing with my finger. See if I can do any better than that. Minus 275 under retained earnings. So retained earnings is going down because of net income, and then our interest payable is going up. So it's a claims exchange. We're going to pay this later when we pay the loan. So that's about all I wanted to introduce to you. The appendix goes on for a bit, and I don't want to get super in detail with it. I just want to introduce the concept of depreciation and interest accrual to you. I really want to have you focus in on the concepts of accruals and deferrals and adjusting entries from the main body of Chapter 2. And that's it. That is the end of Chapter 2. Keep reading, studying, and keep practicing. Do that homework. Let me know if you have any questions. Thanks, guys.